So this week, the assignment was to go through the Q4 reports from three major companies, do a DCF analysis, but ultimately to compare a value investing versus growth investing approach. And to jump into it, what we see here is a dashboard comparing Alphabet, Microsoft, and NVIDIA. What you could see here is the revenue, operating margin, free cash flow, and the R&D intensity. And ultimately, while all of these are very good companies, we see that many of them have high operating margin above 30%, and generally companies with an operating margin above 30% have outperformed the S&P 500 index by a little over 3%. In moving further down to get a bit more insight using DCF analysis, you can see here from the table that we have, comparing Alphabet, Microsoft, and NVIDIA, what's the current free cash flow, the growth rate, the enterprise value, and the terminal value, and the implied free cash flow yield. And what's interesting about this analysis is we can modify the weighted average cost of capital here to ultimately trickle down to get different estimates. And similarly, we can do the same with growth rate here to modify our projections out, or modify the number of years to even go out 10 years. And so from building off of this, below that, you see a heat map here, which is the enterprise value sensitivity, which is essentially plotting the weighted average cost of capital against the terminal growth rate. Moreover, when we look at the value investing approach and break down each company based off these key metrics, the free cash flow, operating margin, capital efficiency, which is the free cash flow divided by the revenue. We can weight each of these by a certain metric and come up with a value score. And by doing so, we see NVIDIA has the best value score, which suggests that from the Buffett perspective, it has the strongest combination of free cash flow yield and operating efficiency. And this suggests it has a sustainable competitive advantage and provides margins of safety through stable cash flow that ultimately may outperform the S&P 500 index in a stable way. However, when we switch to the growth investment perspective of Cathie Woods, we can see here plotting growth rate against the R&D intensity that NVIDIA has a phenomenal growth rate, and it also has a significant R&D intensity. And similarly, when we look at kind of the growth score, we can see NVIDIA strongly outpaces the competitors. And when we take the growth investment perspective, we can see that NVIDIA has the highest combination of revenue growth and R&D investment, strongly positioned in emerging technologies, and demonstrates market leadership in innovation given its R&D costs. But importantly, a key factor here is that high growth tech companies have delivered about 2.5 times higher returns relative to value stocks since 2010, suggesting from this perspective, it may be the better option. Ultimately, growth stocks outperform during periods of technological disruption, but this needs to be countered against changes going on in kind of the whole economic landscape to decide whether we would take a value perspective or kind of a growth perspective in deciding how to allocate our investments. So with that, thanks, and I'll see you next week.